So thanks so much for having me, Marty. Great to be able to beam in via Zoom. As Marty says, so look, I teach finance and entrepreneurship at Harvard Business School. For 20 plus years, I've been giving speeches to the world, making the case, whether it's to my classes or to conferences all over the world, that private equity is fantastic. It delivers tremendous performance on multiple dimensions. The average return is 2 or 3% a year higher than the S&P 500, but also when the market crashes, PE doesn't drop very much, and that downside protection is hugely valuable. And moreover, if you have a portfolio with stocks and bonds in it, then if you add private equity, because the correlation is low enough with stocks and bonds, you get really nice diversification benefits. And so the upshot is that when you look at what institutions have done over the last generation, they've basically gone from 60-40 stocks and bonds to more like 50-30-20, with 20% in private equity. And that has been a huge game changer, massively increasing average returns of the portfolio while also reducing portfolio volatility, sort of the holy grail of portfolio management. So it's been an amazing success story, $4 trillion in private equity, but there's a real question: why isn't it more? The capital markets here are over $100 trillion. Why would you have only $4 trillion? And the answer is, well, there are two limitations on private equity. One is that private equity has access limits, and the other is liquidity limits. Okay, so can we find a way to create liquid private equity that gives broad access with more liquidity, but still captures the benefits of PE? And that's what I've been arguing for 2 decades is possible. And as Marty said, I partnered with Jean-Louis Leloger. Jean-Louis co-founded Strategic Value Partners, SVP Global, which many of you may be familiar with, one of the world's top private equity funds. They manage almost $20 billion. And that was extraordinary for me because, I'd been working on this in an academic setting, but of course, sitting even with, the fact that Harvard Business School is very embedded in the real world, still it's the case that I wasn't a private equity manager. And so there was a lot I didn't know. And Jean-Louis brought all that expertise to the table. And together we built this firm, PEO Partners. We now have 2 products up and running. One of them is super accessible because it's in a mutual fund format, but it's in Canada. It's with joint with our partners at Mackenzie Investments up there. So if you're from Canada, then anyone can invest in that. The other is accessible in the sense that it's available to anyone in the world, but you do have to be a qualified purchaser to invest. And we have been working with wealth advisors, registered investment advisors in particular, as well as family offices and high net worth, and raised a lot of money through those channels. And then we're getting to know people in. We've also really started to build relationships in the institutional world that are super interested in this. Why are people interested? What is the good of this? Well, think of 2 groups of people: people who don't have access to private equity and people who do. And we would argue they both can use liquid PE, but in different ways. So if you don't have access to private equity, let's say you're a retail investor with $40,000 in a 401k plan. Well, of course, it would be great to be able to do with your portfolio what big institutional investors do and get those benefits: higher returns, lower volatility. So that makes sense, right? And it turns out that lack of access extends way further up the ladder than one might think. I mean, say you retire and you have $8 million, right? Well, you're pretty rich. That's a lot of money. But if you want to put 20% in PE the way a typical institution would, that's 1.6 million. You can only make the minimum at one single private equity fund. And even there, you probably can't get into a top quartile private equity fund. The top funds are looking for big $100 million checks. They're not looking for $1.6 million checks. And you really don't want to put 20% of your money into a single private equity fund, because let's face it, a single private equity fund is holding maybe 6, 8, or 10 positions. And those are highly levered nano cap companies. So it's very risky to put so much of your money into such an undiversified portfolio. What you want to do is put 20% of your money into a portfolio of 20 or 30 different private equity funds. That way, you're not taking too much risk on any one company or fund. But that's just not available unless you're up at that ultra high net worth level. I mean, I can tell you, I sit on the investment committee of my kids' school, and our endowment isn't big enough to invest in private equity. We'd love to, and we have lots of expertise on the committee. There's all these, smart Wall Streeters and some other professors and so forth, but we can't invest in PE. So lack of access is a problem that limits people's ability to get into PE. But there's another, and I would argue that half the money in the world, for one reason or another, whether it's regulatory restrictions, whether it's inability to meet minimums, what have you, half the money in the world is unable to invest in PE. And liquid PE solves that problem, because being able to create something that offers wide access, but that has PE style performance, which is what our products do, gets you the solution to that. Just to give you an example, this quarter so far, the S&P 500 is down almost 12%, and our fund is down a little over 6%. So about half the down, and that's probably around where PE will come in. I mean, obviously we don't know how the quarter is going to finish up, but if the quarter finishes around where we are now, I would expect that PE will also be down. When we look at something like the Cambridge Associates Index, will be down about half as much as the market. But when the market's way up, the beauty of PE is that because you're buying equities and you're buying them levered, because when we say PE here, we're really talking about LBO, leverage buyout, and our portfolio matches that leverage of PE. Well, as a result, when the market's way up, we're able to match the good performance of the market. And so if you look at up years, our performance is as good as the market. But when you look at down years, we offer much better protection. And that is really attractive in these times, right? People have struggled to figure out where to put their money now, because they look at stocks, they say, boy, stocks look very expensive and a crash seems quite likely. In fact, arguably, we're in the middle of a crash. But then you look at bonds and you say the expected return is virtually nothing, and yet the downside is huge, right? Because if interest rates go up, look, we saw what happened with the 30-year bond when the Fed cut rates under COVID, and the long bond rate went from 3 to 2, bonds went up by something in the neighborhood of 30%. But the problem is you give that 30% back if the interest rates go back to where they were in 2019. I'm not talking about huge, scary interest rates. I'm talking about just going from bonds paying 2% back to paying 3%. You lose 30% on your long-term bonds. So the potential is out there. People say, oh, well, 60-40 solves my investment problem, because if the market crashes, my bonds will protect me. And I'm writing a paper on this. That's absolutely true. Historically, you look at the last 50 years, 60-40 has only once had a double-digit loss for the year. It's quite impressive, because whenever your stocks have crashed, your bonds have protected you. But unfortunately, looking forward, that's just not where we stand now, because people aren't really afraid of a traditional stock crash where profits go way down. People are afraid of a bond crash where interest rates rise and your bonds are way down. But the problem is stocks are long-term assets too. They're going to crash right alongside your bonds. And so if you're looking for a place to put a significant chunk of money to replace some of the very risky 60-40 scenario that we're facing right now, we would argue that liquid private equity is a perfect solution to that, because you maintain your liquidity, you can get access to it, you can take your money out anytime you want, right? The mutual fund has daily liquidity, the global product has monthly liquidity. And yet, you've got that downside protection if the market crashes, while still participating if the market has a big snapback. And that's what makes this so attractive. All right, let's talk about liquidity. What I mean by that is, let's talk about the problem for people who do have access to PE, because you might say to yourself, okay, this makes sense if people can't get into PE, but I'm a PE investor. Why would I be interested in liquid PE? And the answer to that is, we actually built this product originally for big institutional investors who have access to private equity. And the reason they're interested is managing a private equity portfolio is really challenging, because private equity is what I call triple illiquid. First, as the usual form of liquidity, you can't take your money out when you want it. But then with private equity, you will get a call, a capital call at unexpected moments saying, hey, we need you to send in $1.6 million by a week from Tuesday, and you better come up with that money. And that means you have to have huge amounts of money sitting on the sidelines waiting, because you never know when those capital calls will come. So that's a second form of liquidity. And then there's a third form of liquidity, which is you get your portfolio in perfect balance. Everything's exactly the way it should be. You've got your 20% or 25% PE, just like you want it. And then they sell something and they send you a big check. Now, it's great that they exited a position, made some money. Kudos to them for great investing. But the downside is that you're no longer in balance. Suddenly, you find yourself back in a situation of having money you need to allocate, and you can't allocate it right away. Because imagine you call up Blackstone, you say, hey, KKR just sent me $6 million. I want to put $6 million to work in private equity. Blackstone's going to say, well, okay, great. Our next fund closes in October. And you're like, okay, but will I at least have the $6 million invested in private equity in October? They're like, no, you still have to wait 5 to 7 more years for us to draw all that capital down. You're like, no, I need to get my private equity allocation up now. They're like, no, we don't have a way to do that. Well, we at PEO Partners do have a way to do that. That's what we invented liquid private equity for, is to be a liquidity buffer for people's PE. So say you're supposed to be 20% PE, You keep maybe 17% at a given moment, 17, 18, 19% is in actual PE investments. And then you've got 1, 2, 3% sitting in the buffer. If money comes back unexpectedly, fine, add a little to the buffer. If you get a bunch of capital calls, take it out of the buffer. But you're always 20% in PE. It's just that sometimes you're 17% traditional PE, 3% liquid PE, and sometimes you're 19% traditional, 1% liquid. The buffer moves up and down, but you always keep a proper allocation to private equity. Now, it turns out this is just the beginning of the use cases for liquid PE. So absolutely, it's true that the liquidity buffer is a powerful use case. It's great for startup PE investments. Say you sell your business, you got $100 million. You want to put 20 million in PE, great, go find 20 great funds, allocate $1 million to each. But you're going to have to wait 7 years for that capital to be drawn on. So also take a chunk of money and put it into liquid PE. And then every time you get a capital call, take it out of liquid PE, put it into traditional. You can use it for tactical asset allocation if you get a moment like the early 2020 where the market was crashing, and some people felt the market was overreacting and there were huge investment opportunities. But again, you can't put that money to work in PE right away, but you can put it to work in liquid PE. You can do cool things in ESG. You can do cool things with completion portfolios. There's lots of different use cases for liquid PE, and we're here to offer all of those. So, all right, I told you why it's good, hypothetically, if we could deliver PE-like performance in a liquid vehicle. We claim we can, and now it's my job to show you that we can, because I haven't told you how we do it yet. So the way we do it is pretty straightforward. It's pretty much if you just like turned off your phone for an hour and thought about how you'd create liquid PE, you'd probably come up with something pretty similar to what we've done. Now, we do think we have some nice subtleties to it because I've been working on this for 20 years, and Jean-Louis and I have been building the business together for 4 years. So, we put a lot of energy behind getting the details right. But big picture, what do? Buy what they buy, lever like they lever, protect the downside, because that's what PE does, right? Buy what they buy, lever, protect the downside. That is the PE magic formula, right? They buy the right kinds of companies, they lever them the right amount, and then they protect the downside so when there's trouble, they don't crash too much. Okay, how do we do it? Well, we have the data on what private equity holds. There's over 1,000 LBO funds in the United States, and we've got the data on their aggregate holdings. So we know what's in there. And we can't buy those companies, of course, because they're privately held, but we can buy a portfolio of hundreds of public companies that matches the characteristics of their portfolios. And what characteristics are those? The most important ones are, first, be in the right industries, because private equity is incredibly good at picking industries. And they make huge industry bets. They're super bold about it. Like right now, healthcare is a little bigger than banking in the public markets, but not much. They're similar sized industries. In LBO portfolios, there's 14 times more healthcare than there is banking. Enormous difference. So PE is really smart about the bets they make, and they're really bold about the bets they make. And if you don't make those same bets, if you don't tilt towards the industries that PE is overweighting, sometimes they're overweight energy, sometimes they're underweight energy. You want to follow them and copy what they do, because it's hard to be as knowledgeable as they are about all 24 major industry groups. But it's not that hard once you have the data to copy what they do. And so that's what we do. So we're in the right industries. And then within each industry, we buy the right kinds of companies. Those are what we call LBO-able companies. What does it mean to be a company that's LBO-able? Well, think what a leverage buyout is. The leverage part means they're borrowing 3/4 of the money. So if it's a $100 million deal, they're going to borrow $75 million from banks and others, and they're going to put up $25 million of equity. Now, if you're borrowing 3/4 of the money and you're borrowing at a blended rate of about 8%, that means that every year you have to pay out 6% of the value of the company in cash for interest payments. 6% is a very high percentage to be paying out in interest. In order to do that, you better be very profitable. In fact, the core element that determines what makes a company LBO-able is this: highly profitable, but low multiple. Because if you buy it for 40 times earnings, you'll never be able to pay out 6%. So high profit, low multiple. Here's the great news. Those are the best performing companies in the stock market. Indeed, if you look at why LBO is so successful, the number one reason is they're in the right industries. That's a huge source of alpha for them. We copy it. The second biggest reason, within each industry, they're in the right kinds of companies: high profit, low multiple, the LBO-able companies. We copy that too. Marty mentioned there are 6 things private equity does, and we match 4 of them. Those are the first 2. Then leverage. We lever the same amount that LBO levers. Not that much, as it turns out. Because if you think about an LBO deal, well, yeah, it's 3/4 debt, and that sounds like a lot of debt. But if you look at the public markets, a typical company is 30% debt. And then if you look at apples to apples, not at typical companies, but at LBO-able companies, those companies are about 50% debt. But then the LBO deals are more like 70% debt. So you only need to lever 1.3, 1.4, 1.5 to 1 to get to that same leverage level. And so that's what we do. We lever 1.3 or 1.4 to 1, and that gets you a little bit of extra performance. It increases your volatility a little. And that's why it's so important to protect the downside so that when the crash comes, you're not crashing as much or more than the market, because that's not what PE does. In the first quarter of 2020, COVID hit, stocks were down 20%. If you were levered 1.4x in that, you'd be down 28%, right? Instead, PE was only down 10%. And that's about what our model does as well. We would have been down 7 or 8% in 2020. In fact, we had a live portfolio running with one of our partner firms, and they were down 7% in the first quarter of 2020. So very similar to PE, right? And as I say, again, this quarter, it'll be a while before we see PE's final numbers. But if the market comes in around here, we think PE will be down about half as much. That's sort of where the history says. And that's about what we're doing at this moment. So what can't we do, right? What can't we do? There's two things PE does that we can't do. So I have to tell you, there's the last two things I have to say. I have to tell you what we can't do and why it's okay that we can't do those two things, okay? What we can't do is we can't benefit from inside information the way private equity does. Look, I've been sending my best students off to these PE shops for 25 years, right? I teach investments and related matters, alternative investments at Harvard Business School. These folks want the best, highest paying, most fascinating jobs, and these LBO jobs can't be beat, right? They pay great, and they're super, super interesting and cool. And so my best students go, they're incredibly smart, and they work like crazy, and they do a great job. And first thing they do is they're going to go spend time with CEO, CFO, COO of the company. They're going to learn every secret that company has before they bid on it. And we're not allowed, no one's ever going to tell us the secrets of public companies. And if anyone ever accidentally did, we'd have to not trade it because we'd be in possession of material non-public information. So we can't benefit from inside information the way PE can. And then the second thing is we can't make improvements after the purchase is done, right? That's one of the things my former students do so well. They get out there, they implement best practices at companies, they take local companies, regional or even global. They'll do roll-ups where they'll buy a bunch of related companies and create a big super company with a less competitive environment. So they have tons of ways of adding value, and they're terrific at it, right? And now, one reason the payoff from that isn't quite as huge as you'd think is that PE is an incredibly competitive business. And so if a mom and pop company, I was actually just on the phone with a friend of mine who used to own the world's largest vanilla company, and a private equity company approached him looking to buy the company. They made him a very good offer, but he's a smart guy. So of course he called up JP Morgan and said, guys, can you run a process and get a bunch of bidders in there? They got half a dozen PE firms that were interested in buying him. Plus they got big agribusiness firms. In fact, he ended up selling out to Archer Daniels Midland, who made the best offer. Okay, so the thing is, the typical control premium on one of these LBO deals is over 30%. So a lot of the value that's going to be added by PE after they buy the company goes to the founders of the company who have to be paid. You sort of have to pay up for the right to make those improvements. And some people are skeptical and say that actually wipes out all the value in PE, but we do not agree. PE still adds a ton of value over and above that control premium, but it does cut into the net value added. We argue that after accounting for the control premium, after accounting for being in the right industries and the right kinds of companies, PE adds 1 to 2% a year by having better information than we can ever have. They add another 1 to 2% a year net of everything by making operational improvements. And they add a third chunk of 1 to 2% a year because we protect the downside by buying options, right? That's our mechanism for protecting the downside, is we simply hedge by buying put options to protect against a crash. Now, that's not how private equity does it. They don't buy put options. The way private equity protects against a crash is what's called mark-to-model accounting. And that is to say, if it's the first quarter of 2020 and the markets are freaking out and airline stocks are down 75% because everybody's afraid no one will ever get on a plane again because of COVID, the PE firms say, you know what, we understand why the market marked things down so much, but we think that's over the top. We think the airline that we own here at Blackstone should only be down 30%, not 75%. And they're allowed to do that. Now, people complain about it. Some people say this isn't fair. If the airlines in the public markets are down 75%, your airline should be down 75%. But their view is just because the public markets are panicking doesn't mean that private equity has to panic. And as I say, that's a controversial statement. We stay out of the debate. Our view is simply this. Private equity delivers great value added, and this is the sixth piece of value added, right? The sixth piece is by protecting the downside. I don't know what order you put them in. Maybe this is the fourth piece, is the value added by protecting the downside. And people love that. And so we need to offer that. But we need to do it a different way because we have to mark to market, right? We're holding publicly traded companies. That's how we stay liquid. So we will buy options for protection. And we have a very sophisticated and clever option strategy developed by our partner firm, Gladius Capital, brilliant ex-Citadel guys who have been running, great options portfolios for institutional investors for a decade. And as smart as they are, though, if you're buying insurance, on average, you're going to lose money, right? It's not a ton, but it's another 1% to 2% a year. So 4 things we match, right? In the right industries, buying the right kinds of companies with the right amount of leverage and with downside protection, right? 2 things we can't match. We pay 1% to 2% a year. We underperform by 1% to 2% a year because we can't have inside information, and another 1% to 2% a year because we can't make operational improvements. And then we underperform by a third chunk of 1% to 2% a year because mark-to-model accounting is free, insurance costs money. Add it up, we're behind on a gross basis by 1 to 2 plus 1 to 2 plus 1 to 2 is 3% to 6% a year. So why do we have a decent product offer? Why do I tell you that in the historical testing, and we think in live performance, it will also be true, that we're going to deliver performance approximately equal to average PE. Not as good as top quartile PE. We never tell anyone to get rid of their PE and put it into liquid PE. What we say is if you can't access PE, we fill that slot in your portfolio. And if you can access PE, we are a tool in the toolbox, not a replacement for your PE. But how do we even match the average when I just told you we're 3 to 6 behind on a gross basis? Well, of course, clever observers will have noticed the phrase on a gross basis. As an investor, you do not receive gross returns, you receive net returns. And PE, that I mentioned that my students are very, very well compensated, my former students, they make crazy, crazy money. And so as a result, that has to be funded with fees, and the fees are really high. If you look at private equity fees and you add up the operator fees, monitoring fees, origination fees, management fees, and carried interest, it averages about 700 basis points a year. Our fees are more like 100 basis points a year. And that 600 basis point gap gets us from 3 to 6 behind to 0 to 3 ahead. And the historical testing, it's more like 3 ahead than 0, but we know you're never as good as your back test. So we say humbly that we think we can deliver performance equal to average private equity. And we think that that is super high value added, either as a tool in the toolbox for private equity investors or as a private equity alternative for those who can't access PE. And so that's all I have. I've got 2 minutes before I have to go tell this story to a large group of investors up in Canada. So Marty, if you have a question, or if anybody in the audience has a question, I'd love to answer real quick.
Yeah, Randy, I have a couple of questions, but before I get started, I just want to say that a lot of people will compare the way you speak to like Jimmy Page or Eric Clapton. I like to think of it more like, since we're in Texas, like Stevie Ray Vaughan. It's really you're a great soloist and improvisator.
I really enjoy Stevie Ray. I have to say, Cold Shot is one of my all-time favorites. I love that guy.
And me too. There you go. Right. So, I was going to ask you the question about, are you comparing yourself to average PE or top quartile? But you actually answered it before I could ask it. Mm-hmm. So, maybe you can give I do have a question in the audience. If you can spare 3 minutes rather than 2 minutes, that'd be great. But maybe you can tell us about PE is really changing a lot as well, right? Because as you've already stated, almost any deal that's better than lower middle market private equity goes to auction, right? So we're also seeing a lot of PE funds that are trying to be longer than your 10-year life cycle, because they're saying, well, if we're investing in biotech, some of these take longer to come to fruition, et cetera. Mm-hmm. So you're seeing a lot more diversity. So I guess my question is, what's the capacity for your strategy, given that there's $4 trillion of PE out there?
Yeah. See, what's so great about what we're doing is because we are constantly tracking what PE is up to, as the industry evolves, we will evolve. Look, the people in that industry are so smart. If they're doing something new, it's probably because it's really great. And we'll do it too, because we're just going to follow them in whatever direction they grow. 20 years ago, software was the biggest underweight in PE portfolios. Now it's the biggest overweight. They saw the incredible boom in tech stocks coming, and they moved into it and took advantage of it. And so if they start doing longer hold periods, shorter hold periods, different industries, whatever it is, we can match their approach. And that's great. Now, in terms of our capacity, look, the current fund, we have set to go to $500 million, at which point we'll pause and look around. Now, we have designed it, honestly, we think that liquid PE is going to be a really big deal. We think there's going to be hundreds of billions. I call this jokingly the $1 trillion product. We think there's going to be enormous amounts of money in this space over time. And we will not be the only ones in the space. All the big players are going to end up with products in here. I guarantee it. 10 years from now, you can check me. I'll be back at this event and you'll see that lots of people are doing it. But and look, we will lose clients to some of those. People will say, you know what, I'm going to put it into BlackRock's product. And you know what? I know the guy at BlackRock who runs the group that's going to do this. He's super smart. He'll do a great job. Okay. But what I will say, and I understand some people just want the big name, but our view is I've been talking about this a decade longer than anybody else. We have the first 2 products in the market that are true liquid private equity. And we're the only firm that is dedicated to nothing but liquid private equity and thought leadership. And so when you're talking to us, you'll be talking to the people who this is all we do. When you talk to BlackRock or whatever other big firm gets into the space, which they all will, they're just going to have somebody who this is the latest rotation they're doing after their MBA. And so, we have real passion for this and we think we'll always be on the cutting edge. So how large will we be? Who knows? We certainly would like it to be. As I say, Jean-Louis retired from a firm that manages $18 billion that he co-founded in order to start this. So he has big ambitions. Jean-Louis is very closely connected to philanthropy and he wants to build something big that can make a difference.
Right. And before we get into I just have one question for Blake. Maybe, Blake, do you know how big the liquid hedge fund space is?
$3 trillion.
So the liquid hedge fund space went from nothing to $3 trillion in 10 years. So there's no reason why.
280 billion in 2000.
Right. I'm sorry. Do we have a question from the audience?
Yeah. Are they connected to any wealth advisory platforms you mentioned working with them?
Yeah. Are you in the RIA wealth advisory platform space, Randy?
Yes, exactly. We work with iCapital. We work with iCapital and others, Fidelity, Schwab, and we're very, so we've got the platform connections, and we're eager to meet RIAs. We think this is an absolutely perfect fit for RIA portfolios to help put their clients in. We think it's a way for RIAs to show their clients the deep thinking that they're doing about what's going on in markets, why 60/40 has been so great for so long, but doesn't look the same going forward, and to actually have a solution to that very difficult problem to offer clients. And so I think probably our biggest client is an RIA, and we're eager to talk to RIAs. We think we can really help, and I'm thrilled if we have RIA clients to work with them to do investor calls and other things to really show their investors the deep thinking the firm's doing.
Sure. At this point, can people get to you through like Morgan Stanley or Goldman Sachs?
Not yet. We're not on those kinds of those kinds of.
But you're on iCapital.
Sure, exactly. So
and what's the minimum ticket?
We work with any RIA to build the structure for them.
What's the minimum ticket?
It says $1 million it's $1 million is the official number. We've gone lower, but obviously if an RIA has clients where, it adds up to larger numbers, we're very comfortable with individual clients being
right. So you can take feeder constructs. Got it. Yeah, perfect.
We can. All right. So look, I have to jump. The Canadians are calling to yell at me for not being on their call. So sincere apologies, but we got a late start. So I apologize.